Hello, welcome and thank you for joining. If this is your first time, welcome. I hope you would consider subscribing. And if you are a returning viewer, I really appreciate the support and thank you for spending the next 5 minutes with me. For the benefit of those who are new to the channel, we are trying to create a community of subscribers who are interested in learning more about their insurance within their superannuation. If you are Australian, if you are currently working, then you're more than likely to have insurance as a default arrangement inside your superannuation. The 2018 federal budget foreshadowed a couple of changes within insurance in superannuation. These changes were later introduced as protecting your super and putting members' interest first. Last week, we talked about putting members' interest first, which was implemented in April this year. Today, we're going to talk about protecting your super, which was implemented in July 2019. These two changes were separated because there was an election in between. So while we were able to implement protecting your super in July 2019, PMIF was only just implemented a few months ago. So what is protecting your super? It's all about protecting your account balance. If your account has been inactive for 16 months, then you will lose your insurance cover. This is designed to protect your account balance from the cost of insurance premiums if there's no new contributions coming in and your account is dormant. So I've put together another whiteboard video to help demonstrate some of the key elements of this particular reform. And while it was implemented over 12 months ago, I think it's still important that we cover it off so that you have a complete understanding of the reform. And we will be referring to PYS and PMIF in some of the future videos that we're going to create. So let's revert to the whiteboard video, and then I'll be back at the end to summarize. Let's look at the impact of the Protecting Your Super legislation on insurance in superannuation, which was introduced in July 2019, last year. While you are a member of your super fund, your account balance will steadily accumulate with each and every dollar that is added to it. Each time you get paid, 9.5% of your income is saved in your super account, which represents the contribution your employer is required to make on your behalf. This rate will increase over time. However, due to the pandemic crisis, the proposed increase may be deferred. Each contribution will help grow your account balance, especially if you contribute a little bit extra each time. This is commonly referred to as additional voluntary contributions. From this pool of money, the cost of your insurance premiums are deducted. Previously, as long as you had sufficient monies in your account to pay for your insurance premiums, then you can reasonably rely on your fund to deduct the cost from your account to pay the insurer. But when there's no active contributions coming through to replenish that cost, then your account balance will very quickly reduce. This is why the government introduced the PYS legislation. There may be a very good reason why your account is inactive. You may have ceased work, gone on leave without pay. You may be a casual and have not been scheduled to work for a while, traveled overseas for longer than usual, or left your employer and moved to another fund. Whatever it is, your fund will give you plenty of notice to remind you that your cover may cease if your account remains inactive. You'll receive a reminder when your account has been inactive for 9 months, 12 months, and 15 months. That's 1 month before the cover is about to be cancelled. If you ignore these warnings and you consider insurance to be an important feature of your superannuation, then you'd better do something fast. You need to fill in that election form to let them know that you want to keep your insurance cover even if your account is inactive. But if your insurance has already been cancelled, then you may have one last chance to have it reinstated. What you can do to maintain or reinstate your cover. You can elect in writing to maintain your cover even if your account is inactive for a continuous period of 16 months. Your election remains valid indefinitely until you advise your fund otherwise. Alternatively, you can put a contribution in your super account to remove it from being in an inactive state, and the 16-month countdown will restart again. If your insurance cover was cancelled due to inactivity, some funds offer a grace window period to allow you to reinstate your cover. This can be 30 or 60 days from the date of cancellation, depending on your fund's insurance arrangement. If you contact your fund within the grace window period, you may be able to reinstate your cover without the need to provide satisfactory evidence of good health, salary details, or other information. If you contact your fund after the grace window period, you may be required to provide satisfactory evidence of good health, salary details, and other information before cover can recommence. Note that I'm stating recommence rather than reinstate. Reinstatement of cover means you will need to back pay any premiums due since your account has been cancelled to ensure you have no lapsed period of cover. So the moral of the story is you can still keep your insurance cover even if your account is inactive, but you must make a conscious decision to do that. And you may have your very particular reason why you want to keep your insurance cover, and you must be aware that it could erode your account balance if you're wanting to keep your insurance cover even though there's no active contributions going on, because all that's going to rely on is having enough account balance to fund your insurance premiums. So if you believe that insurance is an important element of your superannuation benefit, then you need to fill in that election form. And that election form will be valid until you ring your fund and actually cancel your cover. I hope that helps. Thank you for your company, and please consider subscribing. Thank you.